Hey everyone, welcome. This is Kathleen Rogers here with Jeff Bochsler. Super excited to talk to Jeff today about home financing solutions for the self-employed borrower and professional. And Jeff has been trusted, great local lender for 20 years. We love working with Jeff here at Zia Group and everyone on the team at Guaranteed Rate. So I'm excited to get this kicked off. And this is going to be a little conversation. We'll have questions at the end that are not being recorded, and then you could replay this and send us questions later as well.
Thanks so much, Kathleen. Excited to jump into this because this is definitely a topic that I come across very often. And I think it's important that you all are getting it out there, that we can make sure that people are clear on what their options are as a self-employed person when it comes to financing a home, whether it be for a purchase or refinance. So let me know. You want to do you want to talk about anything before we dive into kind of like the nuts and bolts about different ways to do this? Or are there things that you've come across with client experiences that are questions that are always nice to make sure we cover today as well?
I think in general, just big picture, home ownership is really valuable, and it's a huge opportunity to own your home. And sometimes when you're self-employed, you're not getting a W-2, you can't really show your income as well. Your income fluctuates, and so you're already under a lot of stress already, working really hard, helping the local community, many of the folks that are self-employed. And so I think helping clients that are self-employed buy a home that they maybe didn't think was possible before is really exciting, and just looking forward to the conversation.
Yeah, and like one of the reasons for me to talk through this and just Kathleen and what she's seeing out in the field and the rest of the Zia group is how often you all get approached by self-employed borrowers to say, well, I got denied by bank X or credit union Y or whatever lender. And so as much as I'd love to buy, Kathleen, I don't think it's possible. And as much money as I have the down payment set aside. Like I'm making the money, but I have too good a CPA, right? Like your CPA is doing a great job of making sure you take advantage of every last dollar that you can write off. And that then hinders you when it comes time to buy a house because you've got to get pre-approved and they're going to look at your tax returns and they're going to look at your net income and they're going to say, oh, your net income is 10% of what your revenues were. And you're like, but I actually brought home so much more money than that. So that it can be very frustrating to be a self-employed borrower in today's lending environment, which is and so but the good news of doing this call and why I wanted to talk about this after talking to Kathleen is both of us were like, this information needs to get out there and it needs to be shared. So hopefully you walk away realizing there's a lot more opportunity as a self-employed person as you might not have expected, and it gives you some more things to noodle on coming into the next months or years ahead for yourself and your planning. So
Yes.
that said, I've only got one major slide and we can talk. So Kathleen, we can talk at length at any of this. Or we can keep it really short and just say, hey, we want to just, plant a bunch of seeds for all of you and then leave it to question and answer. And like she said, you can email, text, call us, drop by our offices, however is useful to you to kick around your specific situation, because these always are an individual experience. And every layer of your qualification, from your credit score to your down payment to how your income is structured, how your entities are structured, etc., will play a role in which of these is most useful for you. So how I tried to structure this even in these bullet points is top to bottom. Top is you're going to get like we always try when people come into my office or talk over the phone, fill out the application is how do we hit the center of the bullseye for loan products, which means best interest rate, lowest interest rate, okay? Most optimal loan product for you. That's what we're always aiming for first. And if that doesn't work, then we move out a layer and a layer and a layer until we find the solution. Because we on our side, really like you get the best product out there for yourself leads to you telling other people the great experience you have, right? So there's every incentive for us to try to find the best interest rate for you. And that really is, even if you're self-employed, it's 2 years of tax returns. And then we take an average of the last 2 years. Okay. So that's, we look at the net income if you're Schedule C, if you've got a partnership, what's your net? What is your net plus how much you pay yourself in W-2 income? We'll give you back some depreciation ultimately for qualifying, but we're going to just figure out that number. We're going to take the average of the last 2 years, assuming they're equal or better. So the last 2 years are equal or the last year is better than the year before. We're going to take the average. 2 years tax returns, we're not going to take the average if the first year is higher than the most recent year. Okay, then we're just taking the most recent year, even though we're looking at the 2-year average, and you're going to have to explain why the last year was lower than the year before. Okay, and it might be the year before was an anomaly year. You had a huge payout right before the end of the year. You had something crazy happen, the market, COVID, whatever, that really benefited your business abnormally. And now the most recent year is just, back to business as usual. And that business as usual is really what we should be calculating anyhow. So that's 2 years tax returns. You're going to get best interest rates. Okay. You're going to get the most normal investor options, which are bank options. We call them investors from us. Okay. The next option is pretty darn common though of late is a 1-year tax return qualifying. So that just simplifies things, one less tax return to provide. These are allowed for individuals that have had their business open for 5 years or more. Okay, so 5 years or more, we can often get an approval from Fannie Mae, Freddie Mac, and a lot of the jumbo investors are now following Fannie Mae or Freddie Mac guidelines. So Fannie Mae or Freddie Mac say, we're good with 1-year tax returns, then the jumbo investor, bank, whomever that we're getting you qualified through, will say, we only want 1 year then. Okay, so you've proven that you can last beyond the 2 years of failure rate, which within the first 2 years, the failure rate is so high, right, for self-employed. And so if you've proven that, and now I've been in business for 5+ years, your most recent tax returns is probably going to give us a good insight into how your business is doing, and we're going to qualify based on that. So if you had a really low 2 years ago and last year was a great year, and we can just use 1-year tax return, awesome, right? We don't need to average. You get the most recent year's income. Like if you're a realtor, right? You've been in real estate for 10 years and 2 years ago was just a tough year. You got distracted, maybe, helping out with family stuff, or just had a weird year and closed a bunch the first of this last year, and got a lot of income the next year. So in that most recent tax year, that would be a situation where you'd love to use just 1-year tax return, right? And so that you're usually getting best interest rates as well. So the first 2 bullet points, you're getting best interest rates, okay? And lowest fees, okay? So both best interest rates, lowest fees. Any questions so far, Kathleen, or commentary of experiences you've had about either of these, or what you've seen people talk about before we go on to the next?
I think I'm interested in talking, well, a lot of people who are self-employed are service providers. So maybe general contractors, painters, plumbers, sometimes attorneys, CPAs, just anyone that's
Cafe
building
owners,
cafe
restaurant owners.
owners,
Yep.
yeah, restaurant owners, exactly. So you've built your own business.
Yep.
And so, again, it's not that traditional, you're getting the paycheck every 2 weeks and it's always the same, because it's never the same, right?
Yep.
And so I think, again, there's many people in this economy that are service providers and are self-employed. So to Jeff's point, congratulations if you've made it longer than 5 years, right?
Mm-hmm.
And we really appreciate your service to the community. And so we just want to help. So I think I'm interested in the tax returns and then the bank statement, because I've had clients that have done both.
Mm-hmm.
And sometimes a client would be like, I have to get my taxes done, and they get their taxes done, and maybe they were denied. But we were able to do a bank statement loan, and they have good income, right? And so I think I'm interested in hearing about this next one and the differences.
Yeah. So where the bank statement is, this is the most common next used loan product. So again, we started with the bullseye. Look at tax returns, you're writing off everything. CPA is really good. And now it's like, okay, we don't have enough income to qualify. So one of the main things for qualification is debt to income ratio. Okay, so that's what your mortgage payment's going to be with your taxes and insurance, plus any car payments or anything else if you don't pay your car by your LLC or your partnership.
Business.
But let's say that's your personal debt, your student loans, etc. All that debt's bundled into a monthly payment. What you pay on that, we're going to divide that into what your income is. Okay, so what's your monthly income? And then from there, we're going to divide and create a debt to income ratio. The love of, come here, Isak.
Sausages.
Okay, thanks. Okay, sounds good. Yeah, can you make sure? Yep. Okay. We'll see you in a little bit.
I would like to put my order in.
Yeah. That is my 5-year-old daughter. Luckily, we get grandparents here today, and they're doing a great job just soaking in all the family experience that you get
We should
around the
mention right
holidays.
now it's the week between Christmas and New Year's.
Yes, yeah. So if you're
Happy
watching this
holidays and
later,
Happy New Year to everybody.
yeah. If you're watching this later, you understand why. But yes, Happy New Year's, Happy Holidays. So circling back the bank statement. So the debt to income ratio. So we've got we'll look at your net income, right, on the 1-year tax return, let's say, and we're not netting out enough income based on how the tax returns are done to meet the debt to income ratio limits. Okay. So we're going to go with, my next review is going to be what's your revenue look like? And here's a real world example. One of my clients, $180-ish thousand of net income, but they were making $2+ million of revenue from their business, okay, per year. So $180,000 after CPA is done with everything, $2 million+ of revenue. We'll just say 2.4 million because it's going to make math easy. Okay, so $2.4 million of revenue. And what the bank statements will do is say, okay, let's look at your business bank statements for the last 2 months, 12 months, or 24 months. The longer they look at, the better the interest rate. Okay, so 2 months is going to be a much higher interest rate than 12, which is going to be higher than 24 months. Okay, so if you've got 24 months of business bank statements all showing for this client $2.4 million on average annual revenue, okay, then we can then take $2.4 million. We're going to divide it by 12 months, which is $200,000 a month of revenue, okay? Depending on the business type, the investor's going to say, Jeff, we can use 50% of that revenue as qualifying income, 40%, 80%. Or actually, I think 70% is the highest. But okay, so either way, in this situation for this client, we were able to use 50%. Okay. So it went from, if you take $180,000 of net income per year, that's $15,000 of qualifying income per month. Okay. If we have $200,000 of revenue, we're going to hit it at 50%. We're really getting $100,000 of qualifying income. So we just went from $15,000 of qualifying income from their tax returns to $100,000 of qualifying income. Fantastic. Now the world is that client's oyster in regards to qualifying, so long as they've got the down payment they need and the reserves they need. Okay, so this is a really useful tool that I see a lot of clients benefit from. And that's not the only like outlier case. I can tell you time and time again where it's, you know, a much smaller number of income for the tax returns. And then what we can use because of the business bank statements is 5 to 10x what we would have been able to use otherwise. Okay, so and the interest rates aren't that much worse for a 24-month business bank statement than the 1-year tax return. So, and the costs aren't that much worse. Okay, so this is a real scenario that you aren't getting raked over the coals to make your purchase happen. And frankly, any little extra money you're paying in interest and fees to get this product versus qualifying and telling your CPA not to write off so much money, there's no comparison, right? Like if that client were to write off a couple $100,000 less in taxes, that's
Legitimate
70,000,
write-offs.
right? So that's
legitimate write-offs.
Let's say they have a 35% tax basis and they're like, I want it to show that I made $380,000 a year instead of 180. Okay. That's 200K. We got 35% tax bracket. That's $70,000 of extra taxes they're paying to qualify for a loan. Like you're not paying that much more on your mortgage payment and your fees and everything. Like go with the 24-month business bank statement, qualify that way, and just be that's the little bit, the fee you pay to get the big tax write-offs, you know, long term. So
can I just jump in real
yeah,
quick?
go ahead, Kathleen.
So quick recap. I'm like sitting at a coffee table and I'm talking to someone about this. And so when you and you're self-employed, so I'm going to say like, hey, we're going to look at all the options. And when I say we, I mean Jeff. Yep. We're going to look at all the options. We don't have to come up with a decision right now, but just broad strokes. Have you done your taxes? Have you done your taxes yet? Right?
Yep.
You have 2 years of taxes. Did your income look pretty good the last 2 years? Did you make more this year than the previous year? So that's kind of the first way that we're going to start. Yep. Let's say you made $300,000, but you wrote off everything that you're allowed to write off. So then you're only, your taxable income is $100,000.
Great. Yep.
So that means what Jeff's going to do is he's helping you find a mortgage that's affordable, and your monthly payment, you're going to be able to shop for a house, let's say that's in this range. This is like your maximum here, because we want to make sure that your mortgage is affordable to you and your business. Now, so another option is a bank statement loan. So the bank statement loan isn't looking behind you at what you made and then what you wrote off and what your actual income is. It's just looking at your income. So you're going to turn over your bank statements, and we're going to see that maybe you're making $80,000 a year or $100,000 or a month, excuse me. Yep. Whatever that dollar amount is that you're making per month, we're showing that as revenue coming in. You're showing that your hard work, your labor, that's revenue coming in. So that third bullet point is being able to get a loan based on the revenue coming in. And so that it may show that you have more money to spend on a mortgage. So it helps you buy maybe a home that you wouldn't have been able to get before otherwise. You got it. And yeah, and then like the always question back on this is, you might be like, I would never want to buy a house that would lead me to something that would need $100,000
revenue a month, or like take home pay a month, right? Then the conversation then always circles back to, my job is to help you understand what's available. The next job for me is to help you understand what's comfortable and what is going to lead you to successful home ownership. So you might still say, I only feel comfortable with, $4,000 housing payment or $5,000 housing payment. And that might not be qualifiable with how Kathleen spoke to the numbers, right? And you're like, but I could definitely afford $5,000 per month. And I'm saying, well, the 2-year tax return to 1-year tax return, you're not going to qualify based on that monthly payment. You would qualify with only a $3,500 monthly payment. Okay, and you say, okay, well, I really want the 5,000. Great, we'll go with the 24-month business bank statement or 12-month business bank statement. One thing that I should clarify on this business bank statement, Kathleen, is that you do need, it's one of two things, but the most ideal situation is business bank statements. Okay, so you do want an actual, if you don't have an account set up right now for your business and it just all flows into your personal account, set up a business bank statement, a business bank account. Okay, so that's going to be really important just for a million reasons, tax wise, whether you're getting a loan or not. But that is an important piece, and it needs to be the name of the business we're talking about, bringing in the money. Go ahead. Anything
That's a
else
good
on that
point.
front?
No, business, yeah, business bank statement too. And
Yeah.
again, yeah, the bottom line is like you want your monthly mortgage payment to be affordable for your family. Are you looking at, when you're talking about debt to income, are you talking about personal debt to income, business debt to income, or
Personal,
both?
personal.
Personal.
So that's really nice there too, right? So because the calculations they're doing of the 50%, let's say, is like taking out, given the type of business and how many, they'll ask you, how many employees do you have? How many locations do you have? Do you have leases? Da da da, right? Because they're trying to figure out what that ratio should be. But they're calculated in the business. Again, they're assuming 50% in this situation is the debt of the business, meaning employee salaries, etc. So that's a great question, really good question. To simplify things even more, we move on to the next one, unless there's any other questions on the bank statement.
1099.
Or real quick, let's go to that 2-month business bank statement. High interest rate, but it might be one of those things where you're like, I've had like a couple great months that are better than others in the past, and now might be the time for me to get qualified. So it might be something that you're like, I just need a couple months and I don't want to have to supply 12 or 24 or something like that. But this 1099, what this is all about is a lot of self-employed owner or the business owners, they have like one contract with one entity that gives them a 1099 at the end of every year, or a couple, right? So it might be just like you're a contracted employee for a big entity and they just give you your 1099 that says $300,000 a year, like whatever that they paid you. And instead of providing 24 months of business bank statements, you just show the 1099. Here's what I got 1099 last year. Here's what I got this year, or whatever. And and that's how you're qualified on income. Okay, so that's another even simpler way to get qualified, is to not have to get in the weeds on business bank statements. And so that's a nice thing for those that are getting one 1099. I mean, even do you get a 1099 as a realtor, Kathleen? So
Yep.
that might be for even you, like your scenario, that would be a easier way to do that.
Yep. Independent consultant, but yeah, 1099.
You got, yeah, correct. So that's simple. I don't think we need to go into more on that. Another one would be and this is a higher interest rate, but could be equally useful, is profit and loss statement. So you've had a great, so we're talking right now at the end of 2023, okay? 2022 numbers, tax returns weren't great, okay? And so I have nothing good on my tax returns, but my 2023 year was awesome. You can do an unaudited profit and loss statement for some of these investors, and show what your profits are for the year. And that could be a way to qualify. So if you've had a really good year that hasn't been inked into tax returns, they'll also do an audited profit and loss, which is usually harder to get from CPAs, more expensive, more timely. CPAs kind of drag their feet about it because they don't like putting their name to something if they haven't actually visited your business and gone through everything themselves. But the profit and loss statement is another solution to getting qualified. We can always do, so some of you might have a lot of just money in your stocks and bonds and cash, etc. We can turn those assets into income. So let's say the 1-year tax return is sufficient to a point, but only gets you that $3,500 housing payment, let's say, and you're like, I really want the 5,000, okay? And you're like, I've got $1 million in stocks and bonds. Well, we can turn the $1 million in stocks and bonds into income to subsidize the shortfall that we're coming up with your tax returns. And now we're back to being at the best interest rate, lowest cost option. Okay, so that's something to keep in mind that you might not have thought of, is like we can turn assets into income. And then
And they're not liquidating
yeah,
in this scenario. They're not necessarily liquidating the stock assets.
you're not liquidating them at all. That's a great point to it. So you don't have to touch them. There's just a
Just
calculation.
documented.
Yeah, depending on the investor we use, there's a calculator that's done of like what they divide your $1 million of stock and by, and then that's what they come up with for your monthly income that they'll use for that debt to income ratio calculation. So that's always useful. No income reviewed. So this is one that's like completely like feels like the stated income of
I
15.
was going to ask that question.
Yep.
Why is that? Yeah,
And it is.
not a fan
Yeah,
of the
yeah.
stated
So
income of the 2008 genre.
yes. So you need a lot of reserves. So you need a lot of money on the sidelines to qualify for these. And it's, there's reasons clients have been interested in this in the past. If none of those other ones fit, they know, hey, I don't show strong on paper. I want to buy this house. I love it. I've got a bunch of money, but I don't want to experience the tax hits, okay, of selling my stock right now. Okay. I've got $1 million on the sideline. I've got another 1.5 million to buy this, and I have another 500,000 I want to put down on this place, and I don't qualify otherwise. Okay. And next year, I'm going to get another $1 million of stock, from my company, or I'm going to sell one of my properties or whatever, right? Like if the story for me, like there's an exit strategy, right? Of like, you're not just doing this to buy real estate. You're doing this because there's a plan in place that either we're going to pay off this loan eventually, or you're going to have a lot more money to be able to pay this loan that we aren't able to qualify you in the normal way. And all of us standing, like if we were just in the room talking to you and look, it makes sense, right? So these are higher interest rate. The points are similar to the bank statements and interest only and unaudited profit and loss. So the cost to doing that loan isn't any different. The interest rates are a little bit higher. And they do require, a little bit more money down. Okay. So they're putting enough chips in their bucket to make them feel like the risk reward is worth it. But yes, if this got displayed across the United States and everyone was using that product again, I have, every bit of concern. The fact is, very few are using it, and it's very strategic when they do. So I think it's a safe product, from what I've been seeing so far.
It sounds to me like you kind of answered the question I had.
Yeah,
It's not stated income. It is something that you've got, it's for our friends and clients that have assets, have reserves. They are able to make the house payment, right?
yeah,
So if something happened, they would be able to make that payment.
you got it.
It's not for someone that is getting in over their head
You
and
got it.
it's going to get in trouble down the road, because none of us, that's not what we want, or
Correct.
or we would even offer advice on how to do something like that, right?
Yep.
So it's not the same thing. It sounds like it's really for people who have the capacity and have those assets and those reserves that they can pull on
Yep.
in order to kind of have this pathway into purchasing a property. And it may not be even like a first time home. It may be more of an investment property.
Yeah, well, and so what I've seen too is either what this is interesting too is we have some clients that are so private, they don't want to give anything
Right.
extra than they have to. So it's worth that money there. Others that are so disorganized that it's really going to cause their life like real, like I don't even know where to start. Like, okay, so those would be other scenarios too. Like, aside from like the big tax hit, if they sold whatever else they would need to liquidate at this time. And so there's a few scenarios. They're not a lot, but there are a few scenarios that this is a really useful product. And what I would always say to any of these products, right, is they every loan tool is can be used for good or bad. And so just it's always like I think coming out of 2008 we saw certain tools were just used with clients that they shouldn't have been used with. The stories weren't figured out well enough. There was negative amortization products. Those can be used for the right people. But in general, it should not be laid out to the public. There are times though when they're useful, and yeah, no tool is a bad one if used with the right scenario, I think ultimately. Um, so that's a great point, and I'm glad you bring that up. Another thing I'll touch upon the last bullet point I have here is vest in an LLC. So a lot of people aren't aware that you could buy with the vesting in an LLC. So just know that that's possible. Only a few investors allow for it, but it is possible. You still qualify with a lot of the same personal data, just so you know. But keeping it in an LLC and protecting whatever, either privacy or wanting to keep the liability under the hood of a business name, you can do that. So
LLC, limited liability company,
you got it.
acronym friends.
Yes.
We throw
So
out a lot of acronyms.
those are all the ways that I see self-employed making it happen. Um, and I'm sure in the next couple of years there'll be more products trying to solve, because we do really see that the government has a very narrow-minded approach on how things are qualified ever since 2008, and that's just leading to investors going, hey, there's this niche of people that really want qualifying for this or need qualifying, this way, and they're a good bet. They're a good bet if I'm going to lend them money. So you're always seeing that kind of like sharpening of the pencil ever since 2008, just a little bit more options for the business owner. So if you get told no, it's worthy of checking in every once in a while. Hey, is there anything
Yeah,
new in my
that-
scenario? Or sharing back,
that's
like, hey,
great.
my scenario's changed this way or that way. Um, don't just count yourself out because you were told no 3 years ago. Definitely, half of these products weren't available 3 years ago. So, be aware that times do change, and it's always good to have, like, I always like to say, like, Jeff on the mortgage side, whether it's me or someone else, and a Kathleen on the real estate side, that you could just be like, hey, this just came up. Just quick question. Have you heard anything new? Have you seen anything new? That you can just text or email or call and get some quick ideas, rather than just ruminate and speculate the answers and never be able to capitalize on some of those big dreams that you have. So that's what we're here for.
Yes, I think this is really, really helpful. I love all the different points that you brought up, Jeff. And, it could be a stressful time when you're thinking about your finances and when you're self-employed and you want to purchase a house or you want to purchase a second home or an investment property or what have you, make that type of decision. And it's not a cookie cutter situation. We want you to be able to have the information that you need to make the decision that's going to be best for you and your family. And, if it's something that's affordable to you and you just didn't think that you would be able to get into a home, and really you have the income, you have the assets, and you just didn't have the path, because you're self-employed. We just wanted to bring these different options to you. Again, Jeff is really good at taking your specific information and laying out the different options, and then you can kind of see what makes the most sense. So I
Mhm.
really appreciate working with you, Jeff, and really appreciate the opportunity working with people that are, again, self-employed, just like me, and make an impact in the community. And just, we are here to help.
Sounds good. Well, thanks so much again for having me, Kathleen. And that said, as Kathleen mentioned at the beginning, we're going to turn off the recording now because we know a lot of you will have questions that you would feel less comfortable sharing if you knew it was recorded. So we're going to pause the recording now. Kathleen, can you let us know when you do that? And then we'll open up to questions.
Thank you, guys.
Thank you.